important to kind of understand the foundation of these chart patterns, which is going to be the candlesticks themselves. Now, I actually have a full video talking about candlesticks in much more detail and going over some candlestick patterns, so I'm going to go ahead and link that down in the description for you to check out after you finish this video. But kind of just to give you the basics of candlesticks, they're going to be made up of four main points, and those points are going to be an open, a high, a low, and a close. Now, of course, we know that the candlestick is going to be green if the open price is lower than the close price, meaning that it went up within the period that the candlestick was open, and it's going to be red if the opposite is true, meaning that it opened at a higher price than it closed, and the price of the stock went down within that candlestick's time frame. Now, that main colored section of the candlestick is going to be known as the real body, and there's going to be a line sticking out from the top and the bottom of the real body, which are going to be known as the upper and the lower wicks, simply telling us the highest and the lowest points that the price went within that candlestick before it closed. Now, that means that this can tell us the open, the high, the low, and close for any period of time, really. It can be over a 1 minute period, it could be over a 5 minute period, it could be over an entire hour, an entire day, an entire week, and that's going to be dependent on the time frame of your chart. So, for example, if we take these three charts here on the screen, on the left we have the 1 day chart, in the middle we have the 1 hour chart, and over here on the right we have the 5 minute chart. All of these are looking at the same stock, just on different time frames. And the reason that I wanted to bring this up is because if you see some kind of chart pattern forming on a longer term time frame, such as the 1 day chart, most likely that chart pattern is going to take a much longer term to actually play out than something forming on the 5 minute chart or even the 1 hour chart. And because of that, a chart pattern on the 1 day chart is probably going to be used for some kind of longer term trade, such as a swing trade, whereas any kind of chart pattern forming on the 5 minute chart or the 1 minute chart, something very short term, is probably going to play out over a much shorter period of time. And because of that, it's going to most likely be best to use that as an indicator for a potential day trade. But I wanted to just mention this because you can use any of these chart patterns for any kind of short-term, mid-term, or even long-term trading style. It's really just going to depend on the time frame that you see the chart patterns forming on. So anyway, with all of that being said, the first chart pattern that I want to talk about is one that I'm going to call the panic bounce pattern. This is actually something that I don't see a lot of information on the internet, so I wanted to share this because it's one that I use almost every single day actually in my own personal trading, and is actually a really great way to trade stocks that have a lot of upward momentum without having to chase them all the way at the highs. And the way that this works is you're looking to actually dip by these momentum stocks at a previous level of resistance or at a previous peak or high. And the reason for that is simply because past levels of resistance, once they're broken, often become a new level of support, and vice versa. Past levels of support that are broken often become a new level of resistance. So by waiting for these stocks to actually break out over these resistance levels and then pull back to that newfound level of support, you're going to prevent yourself from buying immediately as the stock breaks out over resistance, which at the end of the day is going to be a much more accurate way to trade these breakouts, and it's going to prevent you from buying into false breakouts, which is exactly what causes so many new traders to buy stocks as they're breaking out at the high before they come straight back down below that resistance level. So as a quick example here, if we take OCGN, this was a big runner over the past week, and we're looking at the 1 minute chart, so this is of course what you would see as a very short-term trader. Obviously right off the bat you can see that this is a very strong chart with a lot of upward momentum, but if you're watching this in real time, it's of course going to be much more difficult to kind of determine where exactly you should buy into this stock. So by using this panic bounce strategy, there's actually a few really good examples here where you can wait for the stock to break out and then look to buy at that breakout level once it turns into a level of support. And the first of those is going to be right here at about $11 per share. You can see that it spikes up at the market open. It seems to form a peak and starts to pull back below that level. However, it does end up breaking back above that past peak or that past resistance level, which is exactly what we're looking for this strategy. But instead of immediately buying into this peak, because many times, like I said, that ends up being a false breakout, and many times we see these stocks come straight back down after doing that, you want to let it kind of play out and do its thing. It spikes back up, and then wait for that pullback to that past resistance level to now become a level of support. And that is exactly what we see happen here on a few different occasions. These would both be really good opportunities to buy into this newfound level of support. And later on, actually in the day, kind of the exact same thing ends up happening with this peak that we have up here. the stock ends up breaking above that past peak. It starts to kind of consolidate above that, starting to form a new level of support. And from there, it starts to run up and squeeze higher and higher. The next pattern that I want to talk about is another one that I don't see many people mentioning, but it leads to a lot of really good reversals in the market. So it kind of can really help you buy at the lows and sell at the highs, which of course is exactly what we want to do when we are trading stocks. And this is going to be an exhaustion pattern, and more specifically, a volume exhaustion pattern. Essentially, what happens in this case is when the volume becomes quote unquote exhausted after a very strong move to the upside or to the downside, indicating a reversal to the other side. Volume exhaustion can simply be spotted with an unusually large spike in the volume. And to kind of explain what I mean by exhausted, I wanted to give a quick analogy. If you think of a stock that is trending up as a person that is jogging, in theory, somebody that's jogging can kind of jog at a pretty steady pace for an extended period of time, right? But as soon as they start to sprint and they start to go 100%, inevitably they're going to become exhausted and they're going to need to slow down or even completely stop. And kind of the same thing is true for a stock that is trending upwards. It can trend upwards at a nice, slow, and steady pace for a pretty extended period of time. But as soon as it starts to go parabolic and really starts to quote unquote sprint, along with the volume starting to sprint as well, inevitably all of the buyers are going to be exhausted. The demand for the stock that was pushing the price up is going to slow down. And inevitably, that's going to lead to a pullback or even a complete reversal to the downside. So if we take AEZS, for example, another big runner over the past week, you can see this is a pretty good example of volume exhaustion because we have a stock that is pretty slowly trending up throughout the day. It's already up pretty significantly from the previous day close, which was about $1.10, and it's trending at about $1.40 throughout the morning. And you can see that it eventually starts to really pick up and go kind of parabolic. And once we see these big spikes in the volume, that is essentially when the stock is starting to sprint. And again, this pattern can be a really good indicator that the stock is going to pull back or even completely reverse to the downside. And that's exactly what we see start to happen here with AEZS. So if you were using this in real time, if you were in a position and you were looking for a potential area to lock in your profits, looking for these volume exhaustion areas can be a really good way to help you sell at the top of a move. Alternatively, if you want to actually profit from these stocks reversing to the downside, you could look to potentially short sell up here as this becomes an exhausted level, and then you would actually profit as the stock comes back down. And the same is, of course, true for the other side of the spectrum. If this happened to be a stock that was kind of trending downwards and then started to really sell off to the downside with a big spike in volume, that would be known as seller exhaustion. So you could use that information to help you buy down at the bottom of a move before a stock is ready to bounce back up. Okay, and for the third pattern that every trader should know of, in my opinion, this is one of the most valuable patterns that every day trader, swing trader, and even long-term investors should know of. And this is the bull flag pattern, one that you've probably heard of if you've done some research on chart patterns in the past. This is definitely one that is much more well-known than the panic bounce or the exhaustion patterns that we just talked about. But in my opinion, it's for good reason because this is a very valuable pattern and is one that is probably seen more commonly than any other pattern in the market. And what this pattern is a bullish continuation pattern that's going to really help you take advantage of upward momentum in the market and is going to be another one to help you buy breakouts in a stock. And essentially, what this pattern is and how it forms is after a stock spikes up, instead of that stock pulling all the way back down, if it starts to kind of consolidate up at its highs, and you notice that the price action in the chart is starting to get more and more narrow over time, that's exactly what this bull flag pattern is going to look like. And that can be an indicator that this is going to continue to break out, meaning that you can, of course, use it to buy into the stock and profit from that continued breakout to the upside. So if we look at ARYA on the 1 minute chart, again, this was another big runner over the past week. Obviously, hindsight is 2020, so looking at this now, you can see that there were plenty of opportunities to buy into this stock. But if you're watching it in real time, it is much more difficult to spot a good entry point for this stock. That's why keeping an eye out for any of these patterns that are forming is a really good way to actually get started trading with some kind of plan and with some kind of strategy. So if you are looking for the bull flag pattern, again, what you want to see is a strong move up, followed by price action that is starting to get more and more narrow, eventually breaking out and continuing to the upside. And there is pretty much a picture perfect example of this happening here with ARYA. you can see that we get our initial bullish move to the upside. The price action starts to kind of bounce around within this level of resistance and support until eventually the price action gets so narrow that it either needs to break out or break down. But in this case, it does end up breaking out to the upside and continuing on with its run throughout the rest of the day. So the way that you would look to buy this bull flag pattern is to, one, you can of course wait for that breakout over resistance and look to buy that breakout over the next couple of candles. Or another way that you can actually trade the bull flag pattern is to look to actually buy into the pattern itself right above this level of support. But the very important thing to keep in mind about this way of buying into the bull flag pattern is that this pattern is actually not going to be a confirmed bull flag until it actually breaks out above that resistance and starts to continue higher. So if you were watching this in real time and you decided to buy above that trendline support because you're expecting and anticipating a breakout of the bull flag pattern, at this point it's not going to yet be a confirmed bull flag pattern. So most likely you're going to have a little bit lower accuracy by buying before that pattern is confirmed. So in my opinion, your best bet is to simply wait for the pattern to completely form, wait for it to actually be confirmed by this breakout above that level of resistance, and then look to buy